Alrighty, quick market update here for you guys. So, been a while since I've done sort of a market recap. We're going to look at sort of the year in review. So, rather than just looking at October's numbers here, we're going to look at the condo market in general, the rental market, rate hikes. We're going to talk about all of that today, and I'm going to give you my opinion on where we've been and where we might be headed. If you want to book a call with me to talk pre-construction or real estate investing in general, you can do that at precondo.ca/call, and let's get into this. So first thing I want to talk about is the October Market Watch report from TRREB. We're going to go to the third last page here for the home price index. Today, kind of the story of the market over the last year, or really 20 months over COVID, has been, market dislocation and fragmented, in general, a very fragmented market. Obviously, some asset classes doing incredibly well and some not doing so well, specifically condos downtown. But we're starting to see improvements in that space. So I want to talk about that specifically. So if you look at the price in Toronto for single family detached, the index price year over year, we're up 18.74%. Obviously, with a benchmark price of 1.6 million, becomes, just due to lack of affordability, difficult to see that price push too much higher, right? And so that market isn't leading. The markets that are leading, given work from home and flexible working structures, less of a focus on commute and that kind of thing, seeing people, flee to the suburbs for more space for less money. And so when you look at the benchmark price for example, Halton, 33.7% year over year. And that's, if you were to look at from the start of COVID to now, probably 40% plus, because obviously year over year, we're still just looking at, October of last year, which was, the market was running well before that. Peel, 28% year over year. Durham, 36.2% year over year. And Simcoe, 37%. Now, Barrie doesn't have numbers here because Barrie's got their own board. But, Innisfil's close enough, 36.4% type of thing. So the outskirts markets are doing incredibly well. And the gap between, the price of a home in York versus Toronto has shrunk considerably, for example. First thing I want to talk about is just months of inventory. If you're not familiar, months of inventory is the best way to distill supply and demand in one equation. If you have 1,000 listings on the market and 500 sell in a month, you have 2 months of inventory. 1,000 divided by 500, meaning that ostensibly, if no new listings were to come to market, all listings would clear, all the active inventory would clear in 2 months' time. Anything below 3 months of inventory is considered an aggressive seller's market. Anything 3 to 5 or 3 to 6 months of inventory is a balanced market, and 6+ months of inventory is a buyer's market, right? We've been in a seller's market in Toronto, in the GTA, for a long time due to underbuilding and all that stuff. I'm not going to get into supply, like how few homes we're building versus immigration in this video. I have other videos you can go watch on that. But I've put a line here at the 3 months of inventory marker to show you, when we're in a seller's market, when we're in a balanced market. And you can see here at the start of COVID, both detached and everyone froze up. For a very short period of time, everyone froze up. And so, while a bunch of listings didn't immediately come to market, buyers fled the market, right? So you see months of inventory quickly spike from, sub 2 months of inventory, red line being condos, blue line being detached. And then as people start to see, work from home, all these measures, lower mortgage rates, backstopping real estate, all those measures we took, okay, cool. I'm going to get into the detached market because I need more space. I don't have to commute anymore, whatever. So you see, freehold properties crash below 1.5 months of inventory, and still today, well below 1.5 months of inventory. Condos stayed elevated for a bit. So you saw a surge in new condo listings, not as many buyers in the market. And for a period of time there, especially, November through December and even through January, it was a really good time to pick up a condo at a discount versus the prices they were at previously. Whereas freehold just took off and ran. So why do I like MOI, or months of inventory, MOI? Because you can see it in real time as a leading indicator, right? So the dotted red line here is months of inventory. I should have put a line here, but anyways, 3 months of inventory is right here. And then the blue line is the average price of a condo. And you can see instantly, right? So MOI spikes, price is falling. MOI drops, price rapidly rises. And you see here, right, during the start of COVID, MOI spikes, tons of new listings on the market, not a lot of buyers, and you see prices fall a little bit, right? And this is the average condo price in Toronto, but all of Toronto, not just old Toronto. And you can see here, like we dipped for a while, we're more or less back to where, we're back, we've recovered and then some, right? So we've seen price appreciation in the condo space as a whole, but it's very fragmented, right? So Oakville condos are up 25%, but downtown are not. So I want to talk about the premium that has been shrinking. So prior to COVID, it was W06, if you're not familiar, is the Mimico neighborhood. So south of Etobicoke, like south of the Gardner. Great neighborhood, right? And a 10, 15-minute drive to downtown Toronto without traffic. It's a particular pocket that I like to compare to further satellite cities like Whitby. And so prior to COVID, you would pay about a 49% premium right around here, 49% premium. So, your price of a detached in Whitby, $750K, your price of a detached in Alderwood or Mimico, over 1.1 million. Now we're seeing a gap of, these days, only 10%. So Whitby, a detached home in Whitby is a stone's throw away from the price of a detached home in Alderwood, despite their distance, the disparity in distance. Like, yeah, you can see we've done quite well, right? There's a general upwards trend for prices in Alderwood, but nothing like we've seen in Whitby, Barrie, Hamilton. Now, I'm going to pick on Whitby quite a bit. So if you're from Whitby, if you live in Whitby, it's not that I'm picking on Whitby. I just needed to pick a specific satellite city, right? So the same thing, this graph would look the same for Hamilton. It would look the same for Barrie. It's not specific to Whitby. That's just, when people ask me, are we in a bubble? It's like, yeah, some of the market certainly is frothy. These satellites, like Hamilton's up 44% since the start of COVID. That is incredibly frothy. And when you narrow into condos specifically, you'll find that the condo market itself is very fragmented as well. So the blue line here is downtown, so the CO1 condo district, which is a very tight neighborhood of basically just downtown, right? And you can see the pre-COVID peak, we were just over 850K, and currently we're sitting around 830. So the average price is actually lower than it was pre-COVID, and I'll get into that later. But when you look at specific condo buildings, specific listings, what you'll see is that prices are actually much higher than their peak already. But the average shows a different story, and that's why I don't like taking the average for face value. And then the red line here is a Humber Bay condo. So Humber Bay, Park Lawn, Lakeshore, whatever you want to call it, Mimico. What you'll notice is that, Humber Bay did incredibly well through COVID. You can see general upwards trend here. And prior to COVID, a Humber Bay condo on average was about 25% cheaper than a downtown condo. But now it's only about 6% cheaper. And this just goes to show, again, right? People looking for more space for less money. Humber Bay has a lot of parkland, right? Great place to ride out a summer of COVID. You've got, you're not too far from High Park. You have the Humber Bay Park right there, Lakeshore walking trails. So it just goes to show, like, people are associating a premium to parkland that wasn't necessarily previously there. And let's pick on Whitby a little bit more here. Prior to COVID, Whitby detached, on average, roughly cost the same as a downtown condo, right? So you can see here, blue is your Whitby detached, red is your downtown CO1 average condo price. Prior to COVID, they were roughly the same price. You can almost see them trading together, like they're correlated, right? And then COVID hits and Whitby detached just runs and condos just kind of trade sideways for a while. Obviously recovering now, but you can see here that, in my opinion, that's a huge market dislocation. Yes, there's an argument to be made that flexible work from home structures are here to stay in some sort of capacity, in some sort of way. But I think most people will be coming back to the office, if not full-time, 5 days a week. There'll be hybrid models, but commute distance is going to become a consideration again, right? That's the reality. This isn't here to stay exactly as we see it today for an extended period of time. Medium, long-term, people are going back to the office. That's the reality, right? I think we're going to see this correct. Now, I think there's an argument to be made that Whitby Detached will forever now stay elevated above a downtown condo on average. But that gap is definitely going to narrow. And when we zoom into Toronto in particular, and you look at the price difference between an average condo in the 416 and an average detached, you'll notice that it has elevated, right, to basically the biggest gap we've ever seen back in 2017 was about just over $1 million, meaning that, if your average condo's 700 grand, then your average detached 1.7 million. We're right back there today at a slightly over $1 million price difference between the two. That is ripe for correction. If you recall in 2017, you got the stress test, foreign buyers, et cetera. And the result was detached corrected in a lot of areas like York particularly, and condos ran, right? They appreciated 20 to 30% in a single year. I'm not saying that's going to happen again, but I'm saying we have the same conditions where months of inventory for both asset classes are really low, and you have a giant price premium associated with the detached, and condos are, of course, the most affordable entry point in the market. So that's where I think capital flows next. Now, like I mentioned, you can see here that the average downtown condo here peaked pre-COVID. Really crazy in January and February of last year. We've seen multiple offers on absolutely everything, reminiscent of 2017. And then now we're seeing an average price that's actually still below, still below the peak. But when you look at specific condos, you don't see that picture. And I track a lot of buildings, but I don't want to, this video can't be 35 minutes. I don't think anyone wants to listen to me for that long. So I just picked a couple of specifics. So 1080 Bay is a particularly high performing building. It's always been an expensive building, amazing location, right? But if you look at the most recent '08 sale there, $890,000, and it's 512 square feet without parking. So it works up to $1,738 per square foot. If you look in April of this year, same unit on the 21st floor, $755,000. If you look in February, sort of the, just after the bottom of the market, $700,000. And if you look pre-COVID, $690,000. So, we're up, $200,000 from sort of just before the pre-COVID high of the market. Maybe some floor premiums built in. So, $150K on this unit. We could call it roughly $150 to $200K. Another example here, 10 York, recent '08 again, 562 square feet, lake-facing unit, no parking. Recent one just sold on the 62nd floor for $850K. Back in June of this year, $745. And I can tell you, pre-COVID, these units were not fetching $1,500 a foot. And then I've grabbed a unit from Humber Bay here because we were speaking about it earlier. 59 Annie Craig, not the best building in Humber Bay, but certainly not the worst. Right along Marine Parade. So this unit gets lake views, but it's got that curved, hate to see curved floor plans, honestly. But anyways, nice unit, nice view. 975 square foot, 2-bed with parking. Unit 3004 sold for $1.15 million. $1,229 per square foot. In April, you've got 15. By the way, floors don't matter in this building. Every unit is right up against Marine Parade, gets an unobstructed lake view. $988,000, and then pre-COVID, $851,000. Maybe that would have been $900 or $950 at the peak of the market, because this was October 2019. So maybe in January, February, it would have been pushing $950, but certainly would not have gotten 1.15. So again, prices have recovered and then some in most cases. There are buildings and there are some listings I'm seeing selling for almost what they would have sold for pre-COVID, but in most instances, you're seeing, 5, 10, 15% more than that. To talk about the rental market briefly, rental prices are still down, right? So this blue line are the average per square foot rents for condos. You'll notice that we're at about $340 a foot, whereas pre-COVID we were $370 a foot. So we're recovering, but we're still not where we need to be. And then if you look at the months of inventory in the rental market, same idea as the purchase market, right? When you see sub 2 months of inventory, you're going to see very low vacancy rate. You're going to see, prices start to push up. We're right on line with the historical average, right? We're right on line with where we need to be to see rental prices push higher. So that bodes well for rental prices in the future. And you can see here, this gray line where we spiked way up in rental MOI. That is, of course, last year. And the last thing I want to talk about here, the elephant in the room, according to Benjamin Tal, the market is pricing in 6 rate hikes in 2022. 6, assuming obviously a 25-point hike each time. That is a 1.5% increase in mortgage rates. And this is what all, the housing bears are talking about. This is what's going to crash the market. Worth noting, obviously, even at 4 rate hikes, a 1% increase, we're still below pre-COVID mortgage rates. But 6 rate hikes is what the market is pricing in. Honestly, I don't believe it. I don't see it happening. There's a number of reasons why. The most important is, look, I'm not a macro guy, right? I like to focus on condos. I like to focus on the Toronto real estate market in specific, pre-construction prices relative to resale. But that's my focus. I'm not a macro guy. If you want more, if you want sharper input on the macro picture, things like rates and the economy as a whole, then there's better people to follow on YouTube. You've got Steve Saretsky always talking about this stuff, and I echo most of his sentiment. I agree with most of his takes. I do not believe look, you got to remember, rates aren't specific to housing, right? So if rates go up by 1.5%, that applies to all debt, right? Corporate debt, provincial government debt, who frankly, I just don't see being able to withstand a 1.5% rate hike in just a year period. So I don't think it's going to happen that quickly, despite where inflation's at. I just don't see in reality. Maybe they'll do 1, 2, maybe even 3 rate hikes before something breaks and they back off. Obviously, there's way too much corporate and provincial debt to be able to withstand the higher rates. But look, at the end of the day, even if they were able to somehow cram 6 rate hikes in a single year, which, if you listen to Saretsky or you listen to, look, I'm in an interesting position. I have clients who are high-level executives at banks and hedge fund managers, and I ask them all the time for their take on this stuff, because ultimately, look, this is not my expertise, and these guys have built a significant amount of wealth by betting on the market for 30, 40 years. And so I ask them, what's your take on this? And they all tell me the same thing. Look, it's not going to happen. They don't see it happening. But look, let's say they did do this, and let's say we saw 50% of buyers just vacate the market, right? Just put their buying plans on hold as a result. So we'd go from 1 month of inventory in the freehold market to 2 months of inventory, and 1.4 in the condo market to 3 months of inventory. Great. We're still in a seller's market. So realistically, look, I think if mortgage rates were to push up 1.5% in a year, yeah, it would put a lot of fear in the market. And yeah, you'd see the frothier markets definitely correct. Markets that are up 40, 45% in the last year and a half would probably be in trouble in that case. But again, I just don't see it happening. So that is my take on that. You can throw the comments below and come back in a year if I'm wrong. But I think if mortgage rates do go up, or interest rates in general go up 1.5% in a 12-month period, I think we're going to have bigger concerns than just the housing market. And just to talk about predictions, this is why I don't like to make price predictions. If you look at the predictions on Canadian housing prices at the onset of the pandemic from a number of institutions here, these are the dates that these predictions were called. You will notice how wrong everybody was. TD Bank predicted 6% increase. They were the closest. Royal LePage, right? Realtors predicted a 3% decrease. CIBC, 5-10% decrease. CMHC, most notably, most famously, with their 18% decrease in housing prices, could not have been more wrong. They were not even directionally correct. So that is the nature of predictions. I think the interest rate hike predictions will probably fall to the same fate as this chart here. And let's talk about pre-construction prices just briefly here, guys. I've spoken about it in other videos. Inclusionary zoning coming in the new year. Construction costs. This graph here represents construction costs of high-rise apartments. In Toronto, you'll notice the rapid spike recently. These, cost inflation, supply chain issues are putting a new price floor in pre-construction. So you're going to continue to see pre-construction product launch significantly more expensive than resale market, unless the resale market really moves over the next 12 to 36 months, which is something I do potentially see happening, specifically in the condo space, because they are so undervalued relative to other types of housing currently. And that is it for this video, guys. Like this video if you like this type of content, subscribe, leave your comments below, and I will see you guys next week.